Lentra and CNBC TV-18 Digital Lending Summit, Mumbai, India.
All right, following this engaging fireside chat, it's an honor to have with us a very distinguished personality who will present an inaugural address providing an overview of initiatives encouraging credit inclusion and policy interventions for enhancing credit access. We are honored to welcome a luminary who has been instrumental in shaping the financial landscape of our nation. With a wealth of experience and a keen understanding of the intricacies of financial markets, he has played a pivotal role in formulating policies that drive financial inclusion and foster credit accessibility. Please, ladies and gentlemen, put your hands together and welcome me in, and join me in welcoming on stage our distinguished guest, none other than Mr. Jayant Kumar Dash, the Executive Director of RBI, who will delve into the discussion into the advancing credit inclusion through policy intervention. Sir, all yours.
Very good morning. First off, my thanks to the organizers, CNBC TV, for giving me this opportunity here. It's always a pleasure and privilege to be talking to the industry participants for a single reason. It's not always possible for the regulated and regulators to be on the same page, but when we talk to each other, we move from 2 pages of different books to maybe only this page of the same book, and that itself quite an achievement. And as the subject matter has been told, I will just be briefing you on the overview of initiatives that has been taken by particularly RBI in the areas of credit inclusion and all the policy intervention in improving the credit access. In this era of multi-inclusivity, the importance of financial inclusion in general and credit inclusion in particular can never be overemphasized. Every country, regardless of the gradient of their economic development, has their own socioeconomic inclusion challenges even this day. In the scheme of Sustainable Development Goals, that is SDGs, of United Nations, financial inclusion occupies a prominent position, featuring as a target in almost 9 out of 17 goals to be achieved by 2030. Socioeconomic inclusion is often predicated on the degree of access to finance that individuals and MSEs, micro and small enterprises, have to consummate economic activities. Given the scale and depth of challenges around credit inclusion and credit access in India, naturally, it had to be addressed by a panoply of initiatives taken in both government and private sector in a synergistic and mutually reinforcing sequences. It is rightly said that future of financial service is collaboration. We have been successful to a respectable degree, and the visibility of future are clearer right now. For a context of policy initiatives and interventions, the financial inclusion journey in India can be broken down into 3 pivotal phases, namely the planning phase, second is the branding phase, and third is the scaling phase. I think these are the terms which will be very clearly understandable to the industry. The planning phase essentially ran parallel to the various 5-year plans up to 9th plan, that is broadly between 1951 and 2002, involving various centralized approach to reduce the factors of financial inclusion. Just I will underline the focus was on financial exclusion to eliminate that. And it included the initial phase of financial sector reforms in India, which started in 1990s. And the focus was obviously more on agriculture. The branding phase started in 2003. And because these are the classification I am giving, and this branding phase started with the Office of Governor of Reserve Bank of India being occupied by Dr. Y.B. Reddy, who is also credited with coining the term financial inclusion and mainstreaming it in the most regulatory approaches to the central bank. The scaling phase, which essentially represents focus on digital financial inclusion, took off in 2014 in a modest manner with fast taste of digital public infrastructure and at a great speed after 2016 with mainstreaming of multiple digital enablers. Quintessentially, fintech-led inclusion formed the critical mass of this phase. Various open source estimates push the penetration of bank accounts, if not loans, at about 90% of the adult Indian citizens, and thus more people are potentially within the reach of formal sector for inclusive digital lending. The regulatory policy initiatives on credit inclusion essentially involves moving frontiers of formal finance into informal finance, particularly in regard of households and SMEs, as I mentioned. In order to give an overview, I'll try to briefly map the regulatory endeavors of these 3 pages I mentioned with specific reference to credit. The planning phase, at its very inception, RBI was seen as playing special role in the context of development, particularly of agriculture. When India commenced its plan endeavors, the developmental role of RBI came into focus, especially in the 60s, when the RBI in many ways pioneered the concept and practice of using finance to catalyze development. During the planning phases, the focus was to channelize credit into neglected sectors and weaker sections. Thus, the financial inclusion, though the term didn't exist in then lexicon, was interpreted mainly as availability of credit to win away the financially excluded from informal to formal financial service setups. Alongside first phase, alongside the nationalization of banks in 1969, RBI introduced the lead bank scheme during the same year, followed by a mandate to have branches in the rural areas. Priority sector lending mandate in 1974 was again followed up by establishing the regional rural banks in 1975 to improve the supply side of inclusive credit. Agriculture Credit Department, which was a department of RBI, and there was a small cell called Rural Planning and Credit Cell, they found a larger house, what is known as NABARD today, and that was in the year 1982. In 1991 and 92, the self-help group finance model got a boost through RBI regulation on opening up their savings bank accounts. None of these institutions I just mentioned have been considered obsolete as yet, as they keep wearing newer clothes. Now coming to the current stage, that is the branding phase. The branding phase is the middle phase. The term financial inclusion, as I mentioned, was used by RBI Governor Dr. Y.V. Reddy, first in the annual policy statement in April 2005, and it was better exploited in the annual policy statement of 2006. The term was formally defined in the report of Committee on Financial Inclusion, again headed by RBI Governor Dr. C. Rangarajan in 2008. That proved to be the paradigm change in regulatory strategy during this phase by designing credit inclusion not as a program in isolation, but as a part of overall strategy in regard of role of the central bank. You could see the shift in the central bank initiatives in the beginning, the supply of credit to a particular sector, but it was really later captured as a part of the overall regulatory framework for the entire economy. The policy initiatives that helped inclusion during this phase included no-frills account in 2005, which later was called BSBD accounts in 2012. Business correspondent, somebody mentioned in the previously, business correspondent, when it was started in 2006 in a particular context, they have been really in an entirely different avatar these days. The seeds of possibility of direct benefit transfer, which actually started the revolution, it was sowed during this phase with IDRBTs, which was a subsidiary of RBI, taking up a project. A joint effort of all the 4 financial sector regulators, a body called NCFE, National Center for Financial Inclusion, was established in 2013. This is to create the demand side. Now coming to the scaling phase, the branding phase had established the foundation at national level to scale off the financial inclusion to next level, and it went into production mode in a sequence of a trilogy. That is, the Jan Dhan bank accounts announced in August 2014 nearly created a right to bank account for any Indian citizen. UIDAI, set up in 2009, became a statutory authority in July 2016, at the same time as when UPI was also launched. And this boosted the digital identity economy system and the penetration of mobile phone in 2017 with a low-cost data plans hitting a high. This trilogy started the beginning of digital financial inclusion and credit access expansion. On the demand side, RBI again introduced annual financial literacy weeks and promoted grassroots level centers called Centers for Financial Literacy, or FLCs, in the country during 2017. While on a scaling phase, that is the current phase of credit inclusion, the actual and potential role of digital lending is widening in access frontiers cannot be overemphasized. RBI too has taken several initiatives to enable such market-driven innovations and resultant products of business strategies to work towards inclusive finance. As the talk time is limited and doesn't afford to cover the entire gamut of policy initiatives by different agencies and players, some of which could actually be seminal, I'll touch upon a few aspects, generally from regulatory perspective, that could be of interest to the audience present here. The business of finance is special for at least 3 reasons. Namely, its ubiquity, it's everywhere, its centrality to development of the economy. Third, and more important, is its operational dependence on efficient financial regulation. Credits inherently involve unavoidable time sequencing and information asymmetry between 2 parties. And talking of information, to digital lending fraternity sitting here, let me quote the old phrase, all data is credit data, which was again coined by Douglas Merrill, who was a digital lending entrepreneur in New York in 2012. I think that started a new phase globally for underwriting digital loans, and of course followed by accompanying regulations. The non-binary goals of financial regulations has always have 2 peaks. One is the developing the sector, market, products in a stable and sustainable manner without negative disruption. And second, more importantly, protecting the interest of the financial service consumer. Broadly, this is the 2 goals of regulation. The tools available are generally institutional developments, affirmative policies for market development or stabilizing it, and calibrating regulatory boundaries. The regulatory initiatives for credit inclusion and better credit access followed the same principles and path. As everybody knows, access, usage, and quality form the tripod on which credit inclusion grows. It will be apt to bounce off some of the aspects that have been in motion during last few years. I'll be very brief here because most of those present here, they know all about it. First thing about the creating market infrastructure and institutions. The original, cover only a few aspects. The original usage of the word digital lending generally refer to P2P lending, and India was one of the first jurisdictions globally to have a regulatory framework for it since 2017. While 25 registered P2P entities operate today, conformance of some of their business models to the original regulatory intents may need some reworking. The open banking concept for financial information through account aggregators was introduced by RBI in the year 2016. The registration of digital-only NBFCs was introduced in October 2018, and currently there are 17 such NBFCs which have been granted registration for such inclusive finance. The differentiated banking model of small finance banks started operating in 2017-18, which was principally dedicated to inclusive credit by fiat in a technology-native environment. Digital banking units, that is DBUs, introduced in October 2022 as a digitally pivoted differential business model strategy with dual objectives of accelerated digital financial inclusion and availability of digital banking infrastructure to act as experience points to the uninitiated to reduce the digital divide. RBI Innovation Hub was established in March 2022 with the express goal to catalyze financial inclusion in India by enabling access to frictionless financial services which are suitable and sustainable. Among major contributions to inclusive credit, it has helped RBI launch a pilot project and end-to-end digitalization of Kisan Credit Card, that is loans up to 1.6 lakh, in September 22 in select districts of 5 states. The pilot was also extended to dairy farmers of a few societies in Gujarat, of which a mention was made by one of the market participants. This initial effort was upscaled to larger ecosystem now in August 23, known as PTPFC, that is Public Tech Platforms for Frictionless Credit, with 5 loan journeys. One is Kisan Credit Card, second is dairy loans, third is MSME loans, and fourth is personal loan and home loans. And now the total number of 9 participating banks and connecting 13 data service in the pilot. During the past 3 months, the banks have disbursed about 35,000 loans amounting to 2,600 crore, including 25,000 MSME loans amounting to more than 1,000 crore. Now I will dwell a little bit on the policy initiatives in brief. Again, select items. The co-origination model of lending between NBFCs and banks issued in September 2018 got a policy shot in the arm in November 2020 with its upscaling to a co-lending model. As the plinth for creating liquidity for various forms of lending arrangements by main players and within a drawn boundary, RBI came out with transfer of loan exposure directions in September 21 and securitization of standard assets in December 22. Under these 2 guidelines, many of the innovative financial products can be interpreted in terms of its regulatory coherence. The guidelines on digital lending issued in September 2022, supplemented by guidelines on default loss guarantee in June 23, cemented the adoption of the dynamics of the new market that has innovated itself and had created new player categories. While the lending part of the digital lending was common for any other mode of lending, the digital part, regulatory guidelines addressed essentially elimination of possible regulatory arbitrage, improving transparency, and ensuring consumer protection. Further, in order to bring clarity on the governance and internal control mechanism around technology and use of outsourced technology models of banking, where the BAS, the banking as a service model, is really gaining acceptance. 2 directions have been issued, one on information technology governance, risk and controls and assurance practices, that was issued in November 22, and another on outsourcing of information technology services issued in April 10, 23. So this will actually give an impression to other market participants the kind of standards which regulators might want. Now I'll talk indirectly about certain business models, which basically, in general terms, on the regulatory arbitrage and regulatory perimeter. Generally, there are 5 conditions that give rise to regulatory arbitrage opportunities in financial services. Number 1, regulatory regime inconsistency, time inconsistency, economic substance inconsistency, interpretive inconsistency, and information asymmetry. These conditions are not cumulative, and only one of them has to be satisfied for an arbitrage opportunity to arise. It may be difficult to entirely prevent regulatory arbitrage through innovation in the short run due to existence of pacing problems. Hence, any business model that capitalizes on the unfenced points of regulatory perimeter cannot be sustainable in the long run, as the gaps get fenced sooner or the later. The business models of some of the initial digital lenders had to face this situation even when the regulatory perimeter got extended to adapt the new technological innovations. The regulatory complexity in activity-based approach which RBI has adopted faces certain challenges in finding common threads in fintechs that adopt digital lending as a vertical or those who adopt it as a horizontal alignment to their business strategy. Further, platform-based conglomeration of financial services also pose a cross-sectoral implications. proposal to set up fintech repository by RBI Innovation Hub, and proposals to have an SRO of fintechs or digital lenders. These are mechanisms for various lending service providers and fintechs. So this will really help to work around various technical challenges that regulation often faces that give rise to the pacing problem I just mentioned. The proposed blueprint of Digita for application hygiene and consolidated reporting of the for the applications used by the regulated entities is another step in this direction to warn the law enforcement agencies as well as the public. Now, finally, I'll touch upon one of the most important area in the conduct of digital lending. It will not be candid not to say that a positive instrument such as digital lending debuted on the credit access lines in India in a manner that was not so positive, owing to the incidents that are pretty well known. While as a regulator, RBI is always long on technology and innovation, it cannot short its role to ensure prudence and acceptable consumer conduct in the system. While dealing with a highly vulnerable and marginalized group of clientele, the onus of responsible conduct and adhering to fair practices are almost one-sided. Notably, the dependence on informal sector delivers double whammy to target population, which not only aggravates their financials to usurious terms, but also prevent them from accessing the regular protection available in the formal system. As the understanding and sophistication for clientele to approach appropriate grievance redressal is rather inhibited, regulators expect the financial service providers to carry the extra burden of responsible lending. I will mention two aspects which was mentioned by Governor of RBI a few days ago at industry conference. First is about the fair and responsible pricing. And to quote Governor, one has to bear in mind the affordability and repayment capability of the borrowers for inclusive lending. Though the interest rates are deregulated by RBI, it is indeed for lenders to ensure that flexibility provided to them in setting interest rates is used judiciously. A major issue that has been pointed out as not of inclusion or exclusion, but huge inequalities in terms of inclusion. A low-income person has to pay disproportionately higher fees for any financial service than a high-income person does. Second part, which Governor has flagged, is about the borrower selection. He highlighted the risk of sole dependence on model-based lending through data analytics, underwriting loans based on preset algorithms, which in turn are based on certain assumptions without continuous testing, could result in not only financial stability risk through type 1 errors, but also exclusion of deserving borrowers through type 2 errors. Digital lending must have a human face and human supervision rather than work on the laws of large numbers. Third, the dichotomy in inclusive lending consists of tendency to ensure customer loyalty, which doesn't help the deserving borrower migrating to more mainstream lenders with possible cost advantage. This tendency becomes more entrenched by arrangements between the mainstream lenders with low-cost funds and the last-mile players with higher cost of funds and higher required rate of return. The share of data marginalized borrowers need to reduce for inclusive finance to really yield results. For building up timely credit history, RBI issued directions on compensation for customers for delayed updation, rectification of credit information in October 2023. And last, in the conduct side, I will talk about the respectable conduct, essentially around the recovery methods. The so-called end-to-end digital journey often has a conventional patch at recovery stage. The fair practice codes of NBFCs and MFIs were issued by Master Circular in RBI in July 2015, and that has been further articulated or sharpened in subsequent circulars relating to responsible lending conduct as well as digital lending guidelines. Guidelines on responsibilities of entities employing recovery agents was issued in August 2022. Emphasis on transparency, clear communication, proper grievance redressal system, and non-coercive recovery methods are very conspicuous in such guidelines. I will conclude by leveraging digital DPIs, digital public infrastructure. India has already achieved about 80% of bank accounts penetration, a journey that would otherwise have taken 47 years. I'm saying 80% because this research, I'm quoting it from research report, was slightly dated, which will take 47 years through traditional means. So that is the contribution of the digital public infrastructure. This is despite the fact that there is significant digital divide between poor and non-poor and between the rural and urban masses in India. The challenge for regulators is to balance the obvious benefits that fintech innovators may have for growth and welfare with their potential risks. The frontier of innovation in digital lending falls within the remit of RBI, but the innovators do not fall, strictly speaking. The interaction between financial regulation and innovation is a two-way street. My best wishes for the rest of the day and the schedules, and I wish that it provides a non-digital platform to exchange experience and stimulate discussion in favor of inclusive finance and credit access. Thank you.
Lentra and CNBC TV-18 Digital Lending Summit, Mumbai, India.